Now let us discuss the insurance as business service. Before I talk anything about the insurance, let us listen a story of insurance. You know, in a classroom, a teacher used to receive always a complaint from the students that their books are being stolen. So they lost their books. So teacher came up with a good idea that suppose there are suppose there were 50 students in a class. So teacher asked each student to deposit 10 rupees. So 50 students depositing 10 rupees, teacher had 500 rupees. This 500 rupees was used as a fund. So if any student is losing his book, or his book is being stolen, it is being missed, so from this fund he would be given help to buy the book. So this a small idea has been converted into a big industry, big service called insurance. So it is a device by which the loss likely to be caused by an uncertain event. So what was the uncertain event that in that story? Books being lost is spread over a number of persons. Who are those people? Number of persons? All the students of the class who are exposed to it and who prepare to insure themselves against such an event. Correct? So now let us be familiar with some of the terms which we will be using in insurance. So there is a contract or agreement. So what is the contract and the agreement? This is a written document between two parties. Who are these two parties? One is insured, another is insurer. So these parties agrees in return for a consideration to pay an agreed amount of money to another party, right? So this amount which is being paid by the insured to insurer is called premium. So once again, it is a contract or agreement. So this agreement took place between the teacher and the student, right? The students are insured and the teacher was insurer, under which one party agrees in return for a consideration to pay, that is students who are paying the agreed amount. That was what every student was giving. How much? 10 rupees. So this 10 rupees is called as premium to another party. Who is that? The teacher, the insurer, to make a loss or damage or injury to something of value in which the insured has a pecuniary interest. So this word pecuniary means what? Something which is related to money or which is consisting money. So here I am showing you now the pecuniary interest means what? It means the opportunity directly or indirectly to profit or to share in any profit derived from a transaction in securities. Correct? Or in Hindi we can say that some dhan sambandhi, vittiya, arthik sambandhi. So that is called pecuniary interest. So as a result of some uncertain event, this uncertain event is what? Books being stolen. So the agreement or the contract is put in writing and is known as policy. So the agreement which has taken place between the teacher and the student in that story would be considered as the policy, that written agreement, that written document. Correct? And the person whose risk is being insured is called insured. Means in that case the students are insured. And the firm which insures the risk of loss is known as insurer. In that case it is teacher. So you are having a good idea now about, and all the terminology is also very clear. Correct? The basic principles of insurance is that an individual or a business concern chooses to spend a definitely known sum in place of a possible huge amount involved in an indefinite future loss. So insurance is the substitution of a small periodic payment called premium for a risk of a large possible loss. Correct? So the loss of risk still remains, but the loss is spread over a large number of policyholders exposed to the same risk. So the premium paid by them are pooled out, of which the loss sustained by any policyholder is compensated. Correct? So what happens? The risks are shared with others. So from the analysis of the past event, the insurer, means the insurance company or the underwriter, knows the probable losses caused by each type of risk covered by insurance. So insurance therefore is a form of risk management, and this is primarily used to safeguard against the risk of potential financial loss. So ideally, the insurance is defined as the equitable transfer of the risk of a potential loss from one entity to another in exchange for a reasonable fee. And the insurance company therefore is an association, corporation, or an organization engaged in the business of paying all legitimate claims that may arise in exchange for a fee called premium. So finally we can say that the insurance is a social device in which a group of individuals, means the insured, transfer their risk to another party called insurer in order to combine loss experience, which provides for payment of losses from funds contributed called premium by all members. So insurance is meant to protect the insured against uncertain event which may cause disadvantage to him. So now let us discuss some of the principles of insurance. And the principle of insurance are the rules of action, or you can call it the conduct adopted by the stakeholders involved in the insurance business. So the specific principle of utmost significance to a valid insurance contract consists of this following. So the first one is utmost good faith. See, there is a Latin phrase ubermi fidei, which means utmost good faith. This principle required that the insured must disclose all the relevant fact to the insurer. And the second one is the insurer must honor all the promises which has been made in the policy. So they should have utmost good faith on each other. Two parties are involved in the insurance. One is insurer, another is insured, and they should have faith on each other. See, this principle suggests that both the parties, insurer and the insured, must disclose each facts and information related to the insurance contract to each other. Now let us understand this with an example. Suppose Mr. A get himself insured against death for rupees 10 lakh, and he did not disclose this that he is suffering from cancer. He lives for another 3-4 years and dies due to cancer. The insurance company comes to know about Mr. A's illness only after his death. Now under these circumstances, the insurance company is not liable to pay anything to the dependent of Mr. A, as the contract between the insurance company and Mr. A is void now. So in this instance, in this example, Mr. A did not follow the principle of the utmost good faith. He did not disclose that he is suffering with cancer. So the insurance company can cancel the contract. Now insurance company should also clearly disclose all the terms and conditions related to the insurance policy taken by the insured. If it is not done, the insured can also cancel the contract. So basically it refers that no material or important fact should be concealed by both the parties to the insurance contract. Correct? Second principle is the insurable interest. Insurable interest means some pecuniary interest in the subject matter of the insurance contract. Like you should have some monetary interest. If that thing was, whatever has been insured, the object which has been insured, you must be having some kind of financial interest into that, uh, or it will cause a financial loss to you, then it is called as pecuniary interest. So for a valid insurance contract, it is essential that the insured has full interest in the property or life so insured by him. This means that if there is any damage to life or property which has been insured, the insured will have to incur loss due to this damage, and the insured will be benefited if full security is being provided to that. So in the absence of insurable interest, insurance contract is void. Like there are various instances of insurable interest, like interest of husband and wife in each other's life, a lender's interest in his debtor's life, the owner's interest in his property, the employer's interest in the employee's life. So the basic thing which we have to understand here, it is not the house, ship or machinery or the potential liability of that life that is insured, but it is the pecuniary interest of the insured in them which is being insured, right? So this will help you to understand this. There is a very interesting example. Like, can you get a house insured of your neighbor? The answer is no, because you don't have pecuniary interest into that house, right? Otherwise, you can get the neighbor's house insured against the fire, and if it get fired, you will be compensated. So it will be a good business for you. Please, it does not happen like this. You should be the owner of that house. You should be having the pecuniary interest into that house. Then only you will be having a insurable interest into that. And this insurable interest differs with every contract of insurance. For example, in case of life insurance, suppose a husband gets his wife insured because he has the insurable interest into his wife's life, correct? And later on, suppose he divorces his wife. So with this divorce, he does not have now any insurable interest in his former wife, in his ex-wife. Now the insurance contract will not be held void only on such a condition. Hence, in case of life insurance, presence of insurable interest is required only at the time of taking the insurance policy. So when the policy was taken, that time she was the wife of that person, so he has the insurable interest into her life. So in case of even divorce, the person would be compensated at the death of his wife. But in case of fire insurance, insurable interest is required at the time of the taking the insurance policy. So as well as at the time of occurrence of loss. Yeah? Suppose your shop, you got it insured and later on you uh, sold it. So now you are not the owner of that shop, and then if a fire takes place, so you would not be compensated because now you don't have the insurable interest into that shop because you have sold it. But in case of marine insurance, insurable interest has to be there at the time of occurrence of loss. Who took the policy, this will not matter. But when the occurrence took place, at that time, whether you were having the insurable interest into that or not, according to that, you will be compensated. Correct? Then comes the principle of indemnity. Please remember it. All insurance contracts of fire or marine insurance are contracts of indemnity. But the life insurance is not covered under this principle. So, according to it, the insurer undertakes to put the insured in the event of loss. in the same position that he occupied immediately before the happening of the event insured against. So suppose a car met with an accident. So what was the condition of the car before that it met with an accident? The insurer has to compensate that. Please remember this, the principle of this indemnity is not applicable to life insurance because you cannot compensate a person's life. So it refers that the insured can get only the compensation against actual loss and he cannot make profit out of that insurance. Let us understand this with an example, then the things would be more clear. A person gets his stock insured worth rupees 50,000, say for 70,000. 50,000 is the value of the stock and he get it insured for 70,000. So a fire occurs and whole stock get damaged. Insurance company will pay him only rupees 50,000 because the actual value of the stock is 50,000, not the 70,000. On the other hand, if any person gets his stock insured, value of his stock say 50,000 for rupees 30,000 and the whole stock get damaged, he will get only rupees 30,000 in that case because the actual value for which insurance has been taken is 30,000 only. So as per this principle, out of the actual loss and the sum assured, the insurance company will make the payment for whichever is lower. Suppose you got your shop insured and the value of your shop is say 5 lakh and you got it insured for rupees 5 lakh and fire took place there. So the total loss when you calculated was 3 lakh only. So the sum assured is 5 lakh but you would not be compensated of 5 lakh. You would be compensated of that amount only. Correct? So please remember it. You can't make profit out of insurance. Next is proximate cause. It refers that the proximate or the nearest cause and not the remote cause shall be considered to establish the responsibility of bearing the losses. So what happened in this case? The insurance company will compensate for the loss suffered by the insured due to the causes mentioned in the insurance policy. But if the losses suffered are due to the causes not mentioned in the insurance policy, then the principle of proximate cause is followed. So this principle suggests that under the condition where it is not possible to establish the cause of the loss, the proximate cause is followed. Let us understand this with an example. If a ship gets damaged due to constant frictions with icebergs and this causes damage to the stock as well. Now this damage is to stock which is insured, hence the insurance company will pay the compensation. Okay, now understand one more example. Suppose Salman has taken a marine policy to protect his goods from perils of sea. See here the perils means which is exposed to danger or you can say threatened. On the way the goods were spoiled by rats. In such case, no compensation will be given as loss caused due to rats is a remote cause and not the proximate cause. Getting it? So, however, if the rats make a hole in the ship and water sent to enter from the hole and spoil the goods, then Salman is entitled to the compensation as loss caused due to water in a proximate cause.